So first of all, I'm going to introduce Jim Hawley, our first speaker, to actually speak to the why of system level investing and why we're bringing here today. Jim is prolific as both an educator, but also co-author of the Moving Beyond Modern Portfolio Theory book with his co-author John Nakomnik, who's also here today and will be available for the discussion later. So over to you, Jim.
Good, thank you. If Bill gave the really very fast elevator speech, I will try an elevator speech in either a much taller building or perhaps a much slower elevator, or both. So what I want to do is simply give some high-level arguments and overview of the book that John and I wrote, Moving Beyond Modern Portfolio Theory, which came out about 6 or so weeks ago. And our intention in that book is to entirely redefine what investing is, how it's done, and what its true north is. We go back and argue that MPT was indeed a revolution, not so much in the notion of diversification of a portfolio, but in the math that enabled that to become, in a sense, far more scientific, the creation of the efficient frontier of expected return as measured and as contrasted to risk as measured by the standard deviation of volatility. Underlying MPT were three major theories that come out of neoclassical economics, and one perhaps out of financial economics. That is the assumption that motivation of people is rational, the so-called Homo economicus assumption. A second assumption of the random walk, that is essentially, in a simple way, statistically, the market is like a coin toss. And the third, the notion of the efficient market hypothesis in its various forms. The result in MPT was a perfect, easy to understand, powerful explanatory theory, and we argue one that is wrong. Why? Because it assumes away the real world. MPT in our analysis is a one-way valve, which we call, leading to the Mpt paradox, which is markets affect your investment, but your investments do not affect the market. That is, if you believe, on the other hand, academic studies, which suggest somewhere between 75 and 94% of return is in fact due to systematic factors, then you're in a situation where effectively MPT says, focus on what matters least. So that MPT clearly focuses on trading and portfolio construction rather than, additionally, systemic issues that create systematic risk in a portfolio. Why is it one way? Because you can mitigate idiosyncratic firm by firm risk within a given portfolio, but you cannot affect systemic risk. In fact, MPT affects systemic risk. There is a symbiotic relationship between MPT strategies and some systemic risks. Examples would be hurting, financial crises, super portfolios. All investments, in other words, have impact. The examples of unintentional risk would be, again, quickly, index effects. I mentioned super portfolios, risk on, risk off markets. Why did Markowitz, clearly a brilliant mathematician and analyst, not see this? In part because he began his theory with his major article in 1952, when markets in the US were 92% retail. Fast forward today, it's exactly the reverse. High 80s to 90% of markets are institutionally dominated. That is a huge structural sea change, which MPT and the MPT traditions have not yet taken account of. And this led us, in thinking about this, to what we call the third stage of corporate governance. In the book, and in perhaps conversation, we could review the other stages, but the third stage we characterize as beta activism. That is an attempt to address real world systemic issues focusing on the environment, the financial and social systems, not simply on corporate specific issues. And this then gets into understanding in a concrete sense the feedback loops between the real economy, the environment, the society, and capital markets. So investors increasingly seek to impact systems, not just individual firms. And my own favorite example in the last couple of weeks is engine number one, both in terms of its activities that it stimulated at ExxonMobil, but also in its more recent a creation of an ETF, the ticker of which is VOTE. And it's a perhaps very interesting experiment in terms of systemic attempts in using constructs that in a sense came out of MPT, but for very different purposes or additional purposes. So in sum, MPT focuses on its risk target as idiosyncratic risk, the risk technique as diversification, the playing field, capital markets, the goal, least mean variance portfolio. Beta activism or third stage corporate governance as a risk target focuses on systematic risk. The technique is to mitigate risks to the environmental, social, financial systems. The playing field is the real economy and the society and capital markets. And the goal is overall improved market return and market risk and return profile. Examples of beta activism, and again, very high level, and I'm concluding here, would include climate, diversity, income inequality. Examples of beta risk by sector would include things such as microbial resistance in the food chain, mining safety, and issues in pharmaceuticals. That is a super fast elevator. We're at the penthouse. Time to stop.
Thank you, Jim, for our penthouse view. We're going to have time in the discussion to get into maybe some of the practical examples, of which I know there are many in the book, and I know that others here can speak to too. But before we move on to our next speaker, just wanted to take a moment to see were there any questions there for Jim already on from his penthouse view. All clear from the penthouse? Excellent. Nice to see that the vista is sunny and clear from up there, Jim. I envy you in my dark basement here in London in the middle of the night. I'm now going to moving from the how to the what. I think we decided from the why, we'll shift this around a bit. Why, you can see I'm getting confused in the middle of the night. Why to Delilah Rottenberg from the Pre-Distribution Initiative, who is going to speak to us about some of the work that they've done. Delilah is the co-founder of Pre-Distribution Initiative and active in lots of spheres. Many of you will know her, but also author of the recent ESG 2.0, which is looking at measuring and managing risk beyond, as I was mentioning earlier, the kind of enterprise and asset level, and looking at this more systemic perspective. So Delilah, would you like to now take us through I'm not sure which floor of the building, now that we're using that analogy that you're speaking from, but if you can now take over. Thank you, Delilah.
Thanks, Emily. And thanks, everybody. I'm really excited to get into the discussion, and it's an honor to follow Jim present on his and John's work, because it's a foundation to what we do at the Pre-Distribution Initiative. So we're really looking at ESG issues at the investment structure level, the fund manager level. A lot of our ESG and impact investing frameworks really look at ESG and impact issues at the portfolio company operations level. So how is the portfolio company managing biodiversity or worker relations or emissions? And we're really looking at how the capital structure of a company and how the investment structures really influence the company and can constrain it from acting responsibly or support it in acting responsibly. And that needs to get measured and managed. So as Emily mentioned, we recently published ESG 2.0, and I'm just going to do a brief overview of a couple of our key findings in that paper, where we see two main trends that are contributing to systemic risk in the real economy and systematic risk in investors' portfolios. So the first is related to something that Jim mentioned, that capital has become very institutionalized since the 1950s. And now we have pension funds and insurance companies and sovereign wealth funds and endowments. And these investors have huge sums of capital to put to work, and they need to invest in, or they feel compelled to invest efficiently in large funds and large deal sizes. And while one might think that that would keep costs low, and we've seen that perhaps in public equities, it does result in consolidated capital flows to fewer managers and larger deals. And so in private equity, in particular in private asset classes, it can actually lead to unaffordable fee structures for investors that result in very high pay for fund manager executives, and that can exacerbate inequality. Investors also have very little negotiating leverage over their fund managers when they're trying to get into oversubscribed funds. And these approaches can overlook diverse and emerging fund managers, many of whom have very innovative and regenerative strategies and reach different segments of the market. And then as capital chases larger funds and deals, there ends up being a lot of capital chasing the same deals. So in these situations, you have an oversight of diverse business owners. So before we were talking about the fund managers, now we're talking about the business owners and SMEs. We're also looking at very high valuations because the valuations, these companies get bid up. And so that widens the wealth gap even more because very few individuals, as we know from statistics that have been shared very widely, very few individuals in the economy actually own equities, whether that's public or private. And also when you have very high valuations, that can increase incentives for investors to layer on leverage to magnify returns. So that really brings me to the second point, which is investor migration up the risk return spectrum for yield. And that's particularly happening in a low interest rate environment. There are a number of factors that are contributing to this migration up the risk return spectrum, but certainly declining interest rates since the 1980s have contributed, quantitative easing in the global financial crisis and in the pandemic, and this all incentivizes more risk-taking by investors. So that means higher investor allocations to strategies such as leveraged buyout private equity and sister asset classes, including high yield bonds and leveraged loans and CLOs and venture capital and private debt. And so with the exception of venture capital, these asset classes often involve very high debt levels at the portfolio company level. And when a portfolio company is very indebted and highly leveraged, it can push companies to cut costs related to quality jobs, or it might affect the quality and affordability of goods and services. We've seen companies go bankrupt. And so that can be very harmful to portfolio companies and their stakeholders. And then in terms of venture capital, the whole move fast and break things culture and the blitz scaling approach really can be in conflict with long-term sustainable investing. And there are also many growing businesses that aren't growing at a rapid pace, but are growing in a steady state that are overlooked by venture capital as well. And so ultimately, a lot of these asset classes end up resulting in higher risk, not only for investors, but also stakeholders who are not welcoming that risk. They didn't ask for the risk. They're not compensated for the risk. Workers, communities, entrepreneurs, some entrepreneurs are overlooked, some fund managers are overlooked. And it also isn't clear that investors are actually getting the returns that they should be from these strategies because there's so much capital flooding these asset classes, chasing the same deals, not getting the diversification that they need. And so the returns are getting eroded away. So at the pre-distribution initiative, we're really focused on two key pillars of work. The first is getting these issues covered in measurement and management frameworks. And so we're working with the World Benchmarking Alliance and the Impact Management Project and the Principles for Responsible Investment in getting these issues into measurement and management frameworks, ESG, impact measurement and management frameworks. And we're also collaborating with many organizations on launching a task force for inequality related financial disclosures. And I'll put a link to the chat and I'll put a link to that in the chat so that you all can check it out. And then lastly, the second pillar of our work is really collaborating with institutional investors, particularly asset owners and allocators at the top of the capital markets value chain on co-creating more regenerative investment structures and practices together with their stakeholders. And this work stream really recognizes that it's crucial for asset owners and allocators to not only theoretically have a long-term outlook and act like universal owners through corporate governance initiatives, but they also need to align their investment structures, their asset allocation, and their investment practices with that philosophy as well. So that's it for me from now, and I look forward to talking with you all, and I'll put more information in the chat. Thanks.
Thank you, Delilah. So we've had the view to begin with Jim with the why. So looking at why some of the fundamental tools that are currently used are maybe not fit for purpose for the challenges ahead, and then further challenge, I think they're from Delilah, but also beginnings of looking at some of the potential answers on actually what are the risks of this, and how is this sort of becoming at risk of a vicious circle? How do we translate that into a virtuous circle? So to take us a little bit more into the how this time, we're going to introduce Bill again. Thank you very much, Bill, for your system level investing overview earlier. Maybe you can now come in and tell us a little bit more about the work you've been doing with your co-author, Steve Leidenberg, on the 21st Century Investing book. And tell us a little bit more about some of the tools and the frameworks that maybe can take us out of this. Thank you.
Absolutely, yeah. So I'll just jump right into the how, because I think Jim and Delilah gave an awesome foundation for me to build on, and then I'll just give a little bit of tip at the end. But so, like I said at the top, so there are a number of pioneering investors that are essentially implementing a wide range of techniques designed to contend with a lot of this 21st century challenges and dynamics that both Jim and Delilah highlighted. And like I said, these techniques can be grouped according to three broader overarching tactics. So you have field building, investment enhancement, and opportunity generation, essentially that illuminate the path forward for the practice of system level investment. So first, investors start working more collectively, what we call field building. Then they change the way they make investments, what we call investment enhancement. Finally, they create investment opportunities that will improve systems, what we refer to as opportunity generation. So, like I said, these techniques essentially differ from those historically used by conventional investors because they stress these things like collaborative actions, building shared knowledge bases, setting industry standards, so on and so forth. So I'll just give you a couple of examples just to maybe bring it to life a little bit. So investors that are looking to increase the flow of information and communication about a particular issue, say income inequality with peers, initiatives, and the general public. This is a strategy that we call interconnectedness. Good example of this is ShareAction's Workforce Disclosure Initiative, which focuses on improving accountability and corporate transparency on workforce issues. This initiative, it provides 49 members, so it's companies and investors, with comprehensive and comparable social risk data. And they're working all across the sector to really improve things such as occupational safe and healthy, health and safety, workers' rights, and composition and compensation. There are other efforts, so where investors have established standards that discourage investments in industries and countries with practices that violate broadly accepted standards and norms around, yet again, income inequality, or contribute to the development of such standards. So for instance, the Cleaning Accountability Framework, or CAF, a multi-stakeholder coalition of investors, including Australian Super and Mpt Capital, unions, real estate developers, facility managers, academic institutions, all working collaboratively with government. So the CAF promotes RCPs, or responsible contractor policies, to protect the rights of workers who are providing cleaning services to properties owned by institutional investors. They do all sorts of activities, but that's yet again an example of what we refer to as standard setting. There's others, so investors create and participate in the use of financial products that intentionally address, yet again, income inequality through their design, implementation, and measurement. So for instance, this is what we call additionality. Bridges Fund Management, which many of the folks on this call will be familiar with, targets opportunities that create jobs and improve the skills of workers, such as vulnerable young people and aging populations. Bridges also promotes healthcare in historically underserved communities while emphasizing sustainable living. This is really important because in post the financial crisis, one of the big things that hampered the UK's economic recovery was a lack of skills training and adaptability amongst the workforce. This is attempting to try to alleviate that tension point. And then finally, another example, there's 10 of these, but I'll stop at this last one. Investors can reduce levels of, yet again, income inequality by maximizing the alignment of specific investments within a portfolio's asset classes with the social functions that these asset classes were designed to serve, or what we call utility. So for example, Heron Foundation, a private foundation focused on community economic development, utilized 2 fixed income investments, loans and bonds, to build affordable housing in communities in the San Joaquin Valley of California. These 2 investments, especially when issued by governments to support nonprofits, significantly promote the building of infrastructure and public goods. These investments later resulted in a more stable community, further loans from other entities, and the stabilization of self-help enterprises, a local nonprofit focused on building and maintaining homes. So this is just like a high-level snapshot of some of the examples. We cover these things in the book, we cover them in our writing, but what TIP has really been focused on for the last 6 years is, one, putting a name to what we're all essentially talking about, providing a lot of conceptual, empirical, theoretical underpinnings to it, laying a lot of the baseline evidence. We have a database where we profiled over 100 investors ranging in size and location that are doing this, and they're cutting at it from different, what we call on-ramps to the system level highway. And that these techniques that they're ultimately pursuing, they've done it in this kind of uncoordinated innovation. That's where we often describe the industry at. And that to shift to this like next level, which is what we refer to as marketplace building, a number of things have to happen. And in addition to what TIP is now collaborating with all sorts of different players to do, we are specifically doing a few things. One is around an industry needs assessment. So really getting a kind of snapshot of where investors across the market, mainstream to those that self-identify in our neck of the woods, what's their level of familiarity, what are the challenges, opportunities, breakthroughs needed for them to be able to pursue this better? And then what does that look like overall for centers of system level investment practice and really driving more broader industry market transformation? So that's a body of work that we'll be looking to collaborate with everybody that's probably on this call to do. We've developed a turnkey solution, so really a plug and play. You want to build system level investing capabilities, you don't know where to start, and you just want to dime and dash. We've got that. And then finally, we continue to do a bunch of ongoing guidance work in partnership with the Generation Foundation around essentially taking all of these big ideas. There's a reason why I kept highlighting examples on income inequality. That's one of the particular areas that we have as an organization really focused on pre-pandemic. A lot of things that we warned people about that was 10 years off happened just in the midst of writing a lot of our stuff. So we continue to do that kind of guidance, really helping to embrace a lot of the movement around stewardship and really raising that to a systemic level and helping to drive a lot more industry awareness and change. So with that, I will pause and gladly hand it back to Emily.
Thank you, Bill. Lots of rich information there and lots of examples. Thank you as we start to get into the how. I think we can unpack that an awful lot more in the discussion. Sure. But before we do that, there's actually a great question from Ken Pucker in the chat. And I wondered, Bill, we were speaking to you, probably haven't seen that. So putting you a little bit on the spot, but whether you might want to actually address that, because it's a really important question, because some of the examples you've given are a mix of, and I step back, you worked at Bridges that would traditionally be called as impact investing, perhaps. So Ken's question, how do system investing advocates distinguish between systems investing, ESG investing, and impact investing, which perhaps, we all have different connotations of? Is that something you can pick up, Bill?
Absolutely, yeah. So the way that we approach it in the book and generally with our work, conventional investment is essentially the lack of an intentional consideration of environmental, social, and governance factors. We define sustainable investors as the intentional integration and seeking of those factors, but that they are largely constrained to a portfolio level focus. And that's, so it's our portfolios are greener, our portfolios are more socially responsible, but are we actually driving long-term broader change, transformational change? Are we actually influencing the underlying dynamics of these systems that are producing a lot of these kind of pesky outcomes that affect stability and resilience overall? And that system level investors take it that next step where they're saying, not only am I thinking about in a much more kind of intentional way, how I pursue and integrate these kinds of considerations into practice, and something like utility, where you're actually thinking about the function of the asset classes. You want to drive, long evolutionary change, and you're primarily working through public markets. Public equities, fixed income are really great for that. You want to drive revolutionary, disruptive change, you're going to go with venture capital, private equity. So really starting to think about things like that. But we do that with a number of these different tactics that we pursue, where it's just to say, each system in question, these are not all of these ESG all of these ideas, they're not a one size fits all. And each system is going to be strained and stressed in different ways. And the way that you have to emphasize the different strategies you might pursue, both to mobilize your portfolio, but also influence the behavior of other investors and policy. You have to do it all. That changes based on the system that is actually stressed. And so it takes a couple more levels of kind of analysis to really get to it. But we do acknowledge fully that to get to that system level highway, there are a couple of key on-ramps: ESG integration, impact investment, long-term value creation, universal ownership. These are all key on-ramps onto that highway. So hopefully that's helpful. In the book, we have a couple of examples where we go issue by issue, so climate change, income inequality, and health systems, where we draw the distinctions between a conventional approach, sustainable approach, and a system level approach, just as a, eat this, not that, and so people can kind of see what the contrast looks like.
But just to check, Bill, before we go on to, and then we'll bring in Mrt as our final talking heads before we open up the discussion. So thanks for bringing in the questions. Keep doing that, please, in the chat. You mentioned that those are kind of on-ramps, but presumably they're not a necessary precursor, right? You can come straight into this as an investor. You don't have to be, highly experienced in even necessarily ESG integration, let alone impact investing, to start engaging and incorporating this stuff. Just want to check that, Bill, with you.
Absolutely. I mean, Delilah comes out of the belly of the mainstream beast, and I'm sure she would vouch for the fact that sometimes systemic risk is actually a much more digestible thing for mainstream investors than it is for talking about sustainability. It still has in some cases, the heebie-jeebies attached to it.
Well, maybe we can now turn to Mrt. Thank you very much, Bill. Maybe no more talk of heebie-jeebies, but in terms of the where, I think it does take us a little bit into that conversation. So Mrt is the co-founder of Beyond Alpha, and has also written a fantastic piece around linking investing to SDGs and connecting to this. So maybe we can introduce that, Mrt, without bringing on a case of the heebie-jeebies by starting to talk about sustainable development. Over to you.
Yes, great. And again, thanks for very happy to be here with all of you. So as Emily said, we talked about the why, the how, and now I'm going to try to answer the where. Specifically, what's the destination of all of this, right? Where do we want to go as an industry? So if we look at the industry, if we look at the statements from major institutional investors, there is a good agreement that we want to take an active role in solving our world's biggest and more urgent challenges, such as climate change and income inequality, diversity and inclusion, and justice, etc. So we see these big announcements, including the Net Zero Asset Owners Alliance, the Asset Managers Alliance, BRT, and others. And they all point to ESG investing as a solution. Now we're seeing that the size of the global sustainable investment market has now reached a new record high, $30 trillion last time I checked. And we're also seeing a big jump in signatories of the UN Principles for Responsible Investment, the PRI, which has now more than 4,000 members, representing more than $100 trillion in asset under management. But what does this mean for people and planet? And are we better off by this rise in responsible or sustainable investing? And the answer is not very much. And we have now seen ample of evidence that shows that while sustainable investing can help improve, particularly ESG integration, can help improve risk-adjusted returns of your portfolios, it is not resulting in better people and planet outcomes. In fact, we see the achievement of the Sustainable Development Goals, for instance, we're now on track to be achieved 62 years behind schedule by 2092. So this realization should be very concerning for all institutional investors, particularly those that have expressed a commitment to sustainability. And the fact that investors' actions are not resulting in positive change the way we would hope to create, is undermining the credibility of the investment community. So we're going to the wrong place, and we need, in a way, to adjust our GPS. The location, again, as Emily said, of the where we want to go from this. So to do this, we need to fundamentally change the way that we as an industry define and approach sustainable investing. As my colleagues on the call today say, we need to transition from ESG to a system-level approach. And at Beyond Alpha, we see SDG-aligned investing as an opportunity to do exactly that. So we define SDG-aligned investing as a system-level investment model that takes into consideration both the risk and return characteristics of an investment, including ESG issues, as well as the positive and negative impact of that investment in the achievement of the SDGs. And this approach considers not only investing in solutions, as we see in the impact investment side, but also on ensuring that all investment decisions do their best not to undermine the health of our shared social and environmental systems. So how can we, traditional investors, conventional investors justify this shift? So Jim earlier, of course, made a very good point, and the work that he's done with his brilliant book with John talks about the serious limitations of model portfolio theory. But if we look at the SDGs specifically as a complement to that, we see that SDGs provide that system level framework for investors, and we're not seeing issues in a vacuum. We're not thinking of, it's not looking at climate change alone, but it's looking at climate, but biodiversity, equality, poverty, etc. So that's an important piece for a system level mindset, let's say. Also, the SDGs are a proxy for resilience, which when justified a lot, this move for a lot of investors that are focused on quality, let's say, in a lot of these companies. And they also provide this much needed blueprint for people and planet outcomes that, again, we have seen as a big obstacle to create impact. So we have a lot of evidence on some interesting research that we're highlighting on each of these points in our paper. So now that I hopefully convince you that we should consider the SDGs as a new destination for our investment process, particularly system-level investors, where do we begin? So in our paper, we talk about the 3 C's of SDG and investing: conviction, clarity, and consensus. Conviction. We need to start with the understanding or the conviction that the SDGs are interconnected and indivisible, and that their achievement will strengthen the shared social and environmental systems that create these long-term investment opportunities for our clients and beneficiaries for generations to come. So it's not necessarily, we're not going to be able to necessarily have the business case or all the historical data for each of the SDGs, but it really begins with that conviction. I also want to highlight that there's a sense of urgency with the SDGs. As you know, we have 9 years and counting to really achieve these objectives. Now, the second C is clarity, both clarity of definition and clarity of impact. Clarity of definition, it has to do with having a clear and honest understanding of what current sustainable investment strategies do and do not do concerning impact and the achievement of the SDGs specifically. So for instance, while ESG integration looks at information or environmental, social, and governance information and how that impacts a portfolio, which is all good and great, is not looking at how that portfolio is having an impact on the world. So it's that other side of the coin, which is very much aligned with the double materiality concept that has been introduced by the European Union last year. And is, again, something that is also part of the discussion for a lot of the standard organizations, standard setting organizations. So that's the clarity of definition. Now, the clarity of impact is, again, understanding, as Jim also mentioned earlier, understanding that all investments have an impact, and therefore it is necessary to analyze both the positive and negative effects of portfolios' underlying holdings towards the achievement of the SDGs. And the assessment of negative externalities is absolutely core to this work, particularly when we look at public equities. And lastly, the last C is consensus among investors on what's expected from companies regarding ESG performance. So this type of agreement, again, is paramount to really amplify the effect that investors can have on companies' actions and consequently on our shared systems. So just want to mention one piece of research that I think is very important, specifically on the topic of consensus, that shows that one of the key reasons that ESG integration, for instance, is not translating to better companies, people and planet outcomes, is that there's this lack of agreement of which issues matter for investors. In other words, companies are getting mixed signals on what's expected from them in regards to environmental, but particularly on social performance. So we have specific recommendations in our paper for asset owners and asset managers and how they can start making these changes around conviction, clarity, and consensus. And we have also identified specific investment strategies that are best suited to contribute to the SDGs that are considering not only solution, which is on the impact investment space, but also that takes a do not harm approach in public markets. So again, I encourage you to reach out and read the paper if you want to learn more, and looking forward to our discussion. Thank you, Emily.
Thank you, Myrtha, for explaining a little bit about the where, and where might be the consensus, not just on what expected of companies, but also perhaps on what may be expected also from financial institutions themselves. I think it's fair to say that the days of financial institutions, investors and banks, insurers as being seen as neutral is redundant. So I think that's the discussion that we want to open up today. Thank you already for the comments that are coming through. I think we can go straight to those. I can see someone's got their hand up, David. I'd like to go to Mark's question first, if that's okay, but David, please hold that question. We will come to you. And please, others, feel free to put hands up or questions in the chat. But Mark, thanks for joining us again. And you raised a question there about the indirect support that ESG is having. Well, that's actually a comment. So thank you for sharing that. We're not throwing the baby out with the bathwater here. I think there's absolutely value in what Myrtha and others have been saying in what that has enabled in terms of the conversations and how hugely far we have moved since indeed 2001, 2011 to Yangbo's point. But your question is specifically, and I mean, this has taken us straight into regulation and legislation, but I think the question there for Delilah, we're always very close to discussing regulation and legislation when it comes to the financial industry. So let's just go straight to that with your question around what legislative agenda would you look at, Delilah, in order to look at supporting reduction in systemic risk?
Yeah, thanks, Mark. And also thank you for your email the other day. You raised some really great points, and I'm looking forward to engaging further here and offline. In terms of your question here, one of the things that we try to do with the paper is come up with ideas that can be tested in sort of the laboratory of the markets. And so we do have provisions for well, one is just reconsidering asset allocation and thinking about whether there are more regenerative investment structures that asset owners and allocators can allocate to. And then we walk through a whole host of measures of how asset owners and allocators could change their practices to allow them to be able to access these more regenerative emerging asset classes. And so some of those investment structures include revenue-based financing and equity redemptions. And we go through the idea of what would it look like if asset owners and allocators were to put more weight in the middle of the risk return spectrum, as opposed to taking a barbell approach where there's a lot on the low end and the high end. And could that work out better for everybody, including from a returns perspective, because you'd still end up with, a roughly 7 high single digits, low double digits return across asset classes. But the other thing that I think the intervention that we suggest that speaks directly to your question is developing responsible debt practices. So really tying questions around leverage ratios to ESG, and also looking at the uses of funds from debt issuance. So is it just going for buybacks and dividends or dividend recaps for investors? Is it going to unhealthy M&A that's contributing to corporate consolidation and stifling innovation in the economy? These things there aren't really agreed entirely thresholds around some of these. Some of them there are, like 6 times EBITDA is a risky threshold, but we'd like to workshop these ideas together with investors and other stakeholders so that that can then inform strong policy. And I did see the headline about initiatives in the UK, and I think that is actually a great start. I mean, I sometimes question whether we should be more forward on our efforts to influence policy right now, or if we need to take this time in this laboratory, so to speak, to really co-create strong solutions that then get instituted into policy, because lots of policy can sometimes have unintended negative consequences, as we've seen from some of the regulation from the global financial crisis. I've talked a lot, but I also have a view on the, is ESG bad, or has it contributed to good things? I just say, I think we should make ESG what we want it to be. It doesn't have to be that was ESG and it was bad and now we're going to do something else. But that's why we named our paper ESG 2.0, because we just think it needs to evolve and go to the next level. I hope that helps.
Thank you, Delilah. I think indeed that is absolutely the discussion that is going on within the ESG community. We go to David and then Cecilia, I think. But David, please pose your question.
Thank you. I want to thank the speakers today. As I was making notes, I said, okay, my question is for Jim. And I said, well, now it's for Jim and Delilah, and now it's for Bill and Mirtha. So we've covered the gamut. And I'm going to limit it to one, and it's a question about structural. Jim started the conversation about the institutional investor landscape that's right now. You know, very kind of dominant. People used to looking at their assessments of risk, you know, based on a beta ratio, Sharpe adjusted risk, Sharpe ratios. What's going to replace that for institutional investors? I guess that's my first part of the question. It's like, what is that common ground? Because so much of the performance and fees is relevant to related returns, relative returns to their peers or to a benchmark. And the second question is size. The institutional investors in developed markets, in large cities, behind terminals, and a lot of the needs for the systemic risk are on the ground in developing nations and on a small scale to reach them. So how do we reconcile that disconnect between we have large, sophisticated investors in a different geographic region with giant scale and then needs on a small scale in developing nations? So I'll stop at that. Thank you.
Great question. Thank you, Jim. Oh, Jim.
Maybe I could take I
was going to offer it to John, co-author, but go for it.
Oh, John, go on. I've spoken already. I can always come back.
Sure. Hi, everyone. Thanks so much for being there. It's a great question. So here's the issue. The return measurements we have now are all relative return, right? The purpose of asset management for an investor is to create an acceptable risk-adjusted return. That's not an alpha-adjusted risk-adjusted return. It's a risk-adjusted return. I come out of the pension fund community. I used to run New York City's pension funds. I consult to other pension funds and other large asset owners. The reality is you're investing to offset real-world liabilities. For individuals, it's retirement or a college education or a mortgage or just the needs of everyday life. The advantage that large institutional asset owners, pension funds, intergenerational sovereign wealth funds, insurance companies have is they have a defined stream of future liabilities that can be actuarially measured. And so the issue is not Sharpe ratio beating the market, although we'll get to that in a second. It is how well are you offsetting, fulfilling your purpose, which is offsetting your liabilities with the least risk possible. And so I believe that, because let me just give you an example. If the market is up 10 and you're only up 8, you've underperformed by 200 bips, but you've still got $1.08 to offset your future liabilities. If the market's down 10 and you're outperforming, you're only down 8, your Sharpe ratio is actually a lot better. But your real world impact on offsetting those liabilities is you have 92 cents on the dollar. And so if we start thinking about purpose, you actually get there. In terms of mismatches, you know, I've done a lot of work in emerging markets. I was a consultant for the IFC to deal with how banks take risk in emerging markets. And this same sort of, to use Mirtha's phrase, externalities don't count, and relative returns, instead of some sort of holistic, what are we trying to achieve and how well do we achieve it, would go a long way to the way banks led in emerging markets, and actually also minimize their risk profiles. Because what happens is things go in fads, and then you get bubbles and then they collapse. And particularly in some emerging market countries I'm familiar with, where banks are political and their loans get directed. And so I think that when you start thinking about environmental, social, and economic systems and directing assets, whether they're bank loans or private equity or the New York City pension funds, towards things which increase the health of those systems overall, you both can create a better risk-adjusted return when judged against purpose, against the real-world liabilities, and decrease risk at the same time.
Jim, did you want to add
Thank
anything to that? Or...
The only thing I'm not sure it's an addition, but it strikes me that there are some really interesting historical parallels. I don't want to suggest, and I actually don't know of any work that's gone through this systematically. And the parallels are from mostly the 1930s, not just in the US, but pretty much globally, where you had very, very significant financial regulation in relationship to the chaos of the 20s in a whole host of ways. And I think there's a parallel, but a more complex parallel, because we're not simply dealing with the financial elements, and what Delilah said I in general agree with, but we're dealing with, in certain ways, E and S issues, which are even more complex. And then we're dealing with the interaction of all of those. But what that has in common, in my mind, is this issue of what John talked about, of purpose and how you benchmark. And so that obviously goes to what Emily is deeply involved with in terms of the World Benchmarking project. But it seems to me that really does begin to get at it. And it also, I think, if that approach is taken, begins to bridge a gap, which I think exists between ESG, defined in a host of different ways, that is entity, that is corporate, firm by firm focused, and the SDGs, which really come at the issue very differently, but have the focus of purpose. I think there's always a tension there, and maybe that's an inevitable tension. But the issue of focusing on externalities, negative and positive, and in that sense, and to me, that's what impact is about. And if it's not about externalities, then I don't know what it means. And so somehow integrating that into the very notion of, out of Econ 101 of what an externality is, right? And if you take that very straightforward notion, which almost everybody who's, quote, an economist or thinks that way says is real, but if you begin to look at that in terms of what it means, I think that then goes back to, I don't remember who asked the question about, there's the ESG world, there's the impact world, there's the system world. In my mind, these are of a piece, though they're somewhat different pieces, but they're integratable. And that's, in my mind, sort of what the notion of system investing is really all about in terms of purpose.
Thank you, Jim. Now I wanted to come to Cecilia. I think it's Shuda, is that right? Please take the question.
Yeah, and this dovetails really directly from what you just said, Jim. So happy for you or John or others to take this. But what is the definition in your mind from a distinction standpoint of ESG versus impact investing, right? So many of us have been in this field for a while, and we understand that these definitions are changing, and certainly there's new entrants in this space. In the last 18 months, we've welcomed a lot of new folk. And so, yes, I understand it's dynamic, but I'm finding it more and more difficult to have meaningful conversations with traditional asset managers. I'm working with a $10 billion fund manager client right now that does not understand that some of their portfolio being EV and meat replacements is great, but that ESG is talking about the 99% of the AUM that's not. And so I've come up with three, distinctions, but I do not feel like I speak for the community, and I am more than happy to work with and partner with others who have a clearer definition. So you guys literally wrote the book.
Sure.
How do you think about this?
Sure. I think, first off, I actually have a clear distinction in my mind, but it is obvious that the semantics used broadly overlap and are not as clear. So let me just try and deal with this. ESG tends to be outside in materiality. What is the world doing to your company? or to your portfolio. So if you are Intel or Coca-Cola, you actually need clean water to function. And so ESG integration in particularly is a consideration of those environmental, social, and governance risks as they affect your portfolio and your company. Sustainability, and this is, and well, we'll get to it in a second. Impact is, what are your company or your portfolio doing to the world? It's inside out materiality to get to the EU's double materiality standard. That said, the EU's double materiality standard, Jim and I have an issue with, because they seem to somehow think that investors are different than the rest of stakeholders. And I don't necessarily think we are. And so impact is what your portfolio or your company does to the world, inside out materiality. System investing, to riff off of what Bill said, is to understand that those impacts interrelate and that you have to think about them as how they affect each other, and you have to do it in an intentional manner. There are lots of issues with this. Measurement standards aren't yet up to speed. Disclosure standards aren't unified, et cetera. But I would make the distinction on sort of a 2x2 simple quadratic, outside in versus inside out, and corporate or security or portfolio versus the rest of the world, and then layered atop that, systems as part of as a more complex way of viewing what the outside world is.
Emily, if it's okay, I can jump in there because I would like to add something, but I think that's a great start and has so many great questions. So my take on ESG, so I love that John and Jim are talking about purpose, because I think, and as a system level student, as a systems thinking student, it all goes back to what the purpose is, what the purpose of a system is, like, and what it was designed to do. So if you look at ESG, or the way that I think about ESG, and again, coming from the traditional investment industry, it's a risk management tool. It was designed to manage risk and to manage material risk, to John's point. So the SASB world gets, is born, right? And it's a risk management tool. So a little bit parenthesis, why do I talk about ESG or I'm critical of ESG, is because ESG was designed as a risk management tool. It was not designed to create, to achieve the Paris Agreement, to achieve the SDGs. ESG integration is not going to get us to these objectives because it's a risk management tool and it's doing a good job doing. So it's doing what it was designed to do. So my issue with ESG is that all portfolio managers, analysts should be looking at ESG. You shouldn't be patting yourself in the back because you're looking at ESG. That's your job, to look at risk, right? So that's the ESG world. Then the impact world, and this is based on our study because I'm not an impact investor. So I made 12-month research last year and we talked to a lot of impact investors, is around what is designed to provide solutions, right? Intentionality, additionality, there are all these key characteristics of impact investing that are designed for impact to drive solutions. So it's clearly very much focused on or it has been mostly a type of asset in the private markets. And again, we can talk more about impact investing. Now, system, to John and Bill's point earlier, it's around in my opinion, the way that I see it is double materiality, or measuring externalities, is understanding the whole picture of an investing. So it is not necessarily, impact could be a tool to achieve system level solutions. ESG, again, I put it as just doing your job, but system level investing is around the measure of externalities. So I do think that should be the core of any investment that calls itself systemic or system level. So that's my view, but I'm very happy that if we go back to purpose as the core of the definition.
I'm going to add one thing because Desiree put an interesting thing in the chat. It also depends on time frame. As a forestry expert that I was speaking with the other day said, look, when people say things are sustainable, you know, fossil fuels are sustainable if you waited several million years, right? We'd all be dead, but the system would evolve, right? And so there's also sort of a short-termism time frame thinking about sustainability of the systems. Jim and I write in the book that the long term is not just a collection of a series of short terms. There's path dependency on the short term that creates all sorts of kinks and accelerations and things. And so the other aspect of systems level investing is to think about the sustainability of the system for some duration without an interruption in its current purposeful functioning. And that's sort of and that has in some cases scientific bases around planetary limits on the environmental. In other cases, I can't tell you exactly what the Gini coefficient is or should be, but we also agree that income inequality has gotten to the point where it threatens political stability. And so I think that there's also a question of time frame and maintenance of the systems.
Can I just bring in a question there from Adelina? Jim, I know you've got your hand up, and Delilah, you want to come in too. So Delilah, I'll come to you, but Jim, I know you want to speak, but can you think to Adelina's question, which I think is going back a bit on the chat, with the idea of outcome-oriented investing, but isn't there a risk actually that such a path would result in significant changes like downward pressure on human capital across various financial institutions and buy-sell side institutions? Would this not lead this take-up of sort of outcomes-oriented investments to a different form of systemic risk? But Jen, I'd like you to come to that, please. And in addition to what you wanted to respond to, but Delilah, did you want to just come in first?
Sure. I'll try to be brief. In response to the question about pricing in human capital and declines to returns, I think that this gets to a question that came up in our last session about benchmarking, where if we really think about where our financial benchmarks came from, they're based on decades of cheap and free human and natural capital, and so they're inflated. And so in order to more adequately compare ourselves to the rest of the market, maybe we should think about reorienting the benchmark and adjusting it to the historical benchmarks to account for those costs. And Schroders has done some great work to analyze what returns would look like if we had priced in externalities, and that seems like a good starting point. I've actually been talking about this issue with a few of our advisors, and we're probably going to organize some workshopping around it. So if you're interested, please let me know. I hope that answers that question. I also recognize that a few folks in the session might not be familiar with the terms outside in or inside out risks. So just wanted to clarify that, where outside in risks are really, when you're thinking about how is climate change going to impact a company's financials. And that's something that TCFD captures, but it doesn't necessarily capture the inside out risks. So how does a company or how does an investor actually impact climate change or inequality? So I hope that's helpful for framing. And I've had a hard time following the chat, but I feel like there's more to address, but I'll stop to allow others to jump in.
Yeah, Jim, can I come to you with Adelina's question, which goes back a bit, which I didn't want us to skip over.
I'm looking for the question. Maybe you could restate it since it's
yes, it does go back. I've gone back too far now, but it was the risk that I think she's raising. Adelina, feel free to come off mute and chime in if you wish. It's the benefits of outcome-oriented investing seem fantastic, agree with that, but isn't the reality that a path, if there was significant shift towards such investing, would result in significant changes, downward pressure on human capital? That's with the shifts out of industries. I'm assuming that's what you mean, Adelina, but please clarify if not. And any thoughts on would this not lead to a different form of systematic risk, essentially?
Hi everybody. I'm on. on video. Maybe I should clarify somewhat. What I meant is we were talking about purposeful investing, which I believe in, and it's critical. So for me, it's outcomes-oriented investing, whether it's liability matching or retirement outcome. So, and essentially what we're saying is remove the short-termism, focus on what's long-term and what's truly necessary. But the reality is that our industry is really focused on short-termism. And if you look at buy-sell, rating agencies, credit agencies, pensions, and so forth, financial institutions, we're all employed on behalf of more of a short-termism lens. So if we go down the long-term path, which I do believe is necessary to address systemic risks and so much more, we're almost saying that we would need to reduce our industry rather significantly. So is that in itself, that reduction in human capital, not a systemic risk too?
I mean, I don't think this is a unique situation. Industries go through ebbs and flows, producers of buggy whips reduced human capital for those machines and individuals who made buggy whips. Transitions are obviously critical. We could get into a whole host of labor market conversations, active labor market policies, success and failures, role of the market, and so on and so forth. But human capital at the end of the day and over time can both be obviously trained, educated, and within some elements moved around. So industries ebb and flow. I think that is a not irrelevant concern, but I think it's a very secondary one. I don't think, if properly managed, it leads to systemic risk or systematic risk in the way, at least I think about it.
Nor do I think it's necessarily, I don't know that I agree with you, to be honest. If you are a portfolio manager and someone says, I want you to manage for a 5-year time horizon rather than next quarter, there may be competitive pressure from someone who's managing for the next quarter, but you also get to match your clients. I mean, I'll just tell a very quick anecdote. Generation Investment Management manages, for a 5-year horizon. They get hired by a pension fund, true story. The first month passes and the head of public equity calls him and says, so what happened? And he said, why are you asking me? He said, well, I have to write a monthly review. He said, you hired us because we have a 5-year time horizon. And the guy keeps on saying, but I have to write a review. I have to write a review. He says, okay, I tell you what. These are the 10 stocks that went up. There were more buyers than sellers. These are the 10 stocks that went down. There were more sellers than buyers. And you could report that for the next 59 months. Then come talk to me, right? So it's more a reorientation of the industry than a diminution of the industry.
That's very optimistic, John. Thank you for that.
Could I just
Bill, come in? Yeah.
Yeah. So just one of the things I think too that what's interesting about this question. So if you take away like only a few keywords from this presentation, complexity, interconnection, and feedback loops, those are the three trigger words that I would give. And I think that's the thing. So there's others that have done really awesome work. The Just Transition folks, David Wood, Vonda Brunstein, others that are looking at that shift from, if you're shifting more climate resilience, what are the implications for labor? And that's part of like the whole thrust of this, right? Is that, I mean, even when we struggled with, okay, how do you begin to measure progress at a system level? And this was a big area of work that we did, and we put together a paper that only a few people read, and it was kind of a shot in the dark. But it was just this idea that we were trying to capture this idea of, okay, each of these systems, when they get strained in different ways. And ultimately what you're trying to foster is durability, is resiliency. And so a lot of the indicators of systemic health that we were starting to try to articulate spoke to that. So in an issue like climate change, it's a lack of adaptability. That's part of the problem. We have a predominant reliance on fossil fuels. We can't transition away from that very easily. That's the problem there. In an issue like income inequality, there's a lack of connectivity. David Weil out at California, he he's done a lot of stuff on the featured workplace and this disconnection between shareholders all the way down to the lowest paid worker. So it's the way that you think about these issues, but you don't think about them in a vacuum. And I think this gets to this other kind of the levels and utility of these different lines of thinking, whether it's ESG integration or something else, where it's to say, we're going from an analysis of individual securities. Then the big innovation was we're going to look at a basket of securities funds. Then we're going to say, now we're looking at the context of the securities and the way they're operating. You can't, this is one of my biggest criticisms of the SDGs, and it's not just mine alone. Everybody here has probably expressed it, but it's like, you can't look at these things in isolation. Like the moment you do, you're doomed to perpetuate the same problems over and over again. And you can get to the unintended consequences and all that. And so I guess it's just to say that that's part of I think the novelty of what Delilah's work, Myrta's work, John and Jim's work, and our work is really trying to capture that thing. So you don't, when you make the shift, that you're not going to solve systemic problems if you're if your starting point isn't, I want to reshape paradigms. And then, because you can do all these things that we're already doing, but if you're not actually aiming to, that's why the bridges example where somebody said, well, that's impact investing, whatever. And it's like, right, except that they're connecting that to this idea of how do we respond in a financial crisis. And if lack of skills training was one of the big hampering to the economic response or recovery for the UK, that's why that is an interesting investment. A lot of impact investors, great ideas, right? But if they're just drawing vague alignment with the SDGs, they get to the problem Myrta's talking about. Well, we're never actually going to solve them, right? And if you're just measuring the impact of your portfolio, well, you're still not then understanding your contribution or the contribution of investors to actually reshaping some of these systems and some of these problems. So that it's super complicated, right? But that's what we're trying to get to. So to your point, we're avoiding a lot of those unintended consequences, or trying to.
Thank you, Bill. I'm aware that we said at the outset there'd be 75 minutes that did come out longer in your calendar. If you need to drop off, of course, feel free to do so. Otherwise, I think we can continue for 15 minutes in the discussion. There's more questions to ask, but feel free, of course, to drop off at any point. Do want to take Ken's point, and then we'll come to Yangbo afterwards. But Ken made a great question about the impact accounts, various different approaches of this over the last few years in terms of monetizing externalities. Do we think this is a leveraged intervention? Myrta, would you like to come in on that one? Thanks for others' reflections in the chat already on that.
Yes. And so just a brief comment on that, because we look at that as part of our research last year on SDG investing. And the view is, or my view is speaking from a lot of the investors that we interview, is that first of all, it's going to be really hard to monetize these type of impacts, right? And even if you do, there's going to be so much, they're not going to believe these numbers, right? In a way is that we're already talking about, if we look at ESG, which is a pretty straightforward case, we look at climate, pretty straightforward, we have the data, it's proven in a lot of ways. And if even if that is still a struggle for a lot of investors, imagine when we look at the social piece, right? So that's why we, the first C in our view from Beyond Alpha, it's conviction. Do you really need to make the business case or evidence of materiality that child labor is not good for your business? Is that really what you need in order for you to ask companies to look at their practices? So we think in a way it's kind of that procrastination strategy, to borrow from one person that we interview in our paper. Is this is just procrastination strategy. We don't have time. This is going to take forever. And if at the end of the day is really hard numbers that you need, you're probably not going to believe in those numbers anyway. So I'm a little, again, I think it's a great effort, and I'm very, again, supportive, and I'm really curious to see what they have to say. But I do believe that is that conviction, that leadership, that point of view that is going to lead the way.
Interested in any other thoughts on that? And there are obviously different forms of it and different applications, some coming from outside, coming from within the institutions. But Yangbo, I want to come to the question. You had your hand raised.
Definitely that. Just wanted to bring up what has been going on in one of the back channels about with Shu earlier about how do we determine something like additionality, and to that, what has come to mind is the difference between, actually quite many similarities actually between ESG and impact, SDG aligned investing, what they call it, and then compare that to how public sector investments are applied. For instance, that for those of you familiar with how tax incentives operate, there is what's called the but-for test, as in without this, was even happen. So would happen anyway, because if it did, then it would just been an information grant to the private party that he basically just wasted a whole bunch of taxpayer revenue right there. So that's what was in discussion earlier with Shu about how are we able to demonstrate it. And what also came to mind there in the course of that was perhaps we can adapt the criteria that the European Commission used for state aid, as in evaluating what constitutes a legitimate use of state aid, and using a very similar type of framework with modifications to adapt to a much wider range of actors, not just the ones more established, but adapt that so we can, for one, evaluate additionality based on a fairly rigorous but for criteria, that's for one, and secondly, is that at least as far as the fiscal level is such concerned, that at the very least ensure that whatever counts as ESG, SG, or impact is nonetheless still a bankable investment, as you're not putting anything into anything concessionary, anything that would not be even viable or desirable in the first place.
Thank you, Youngbo.
Can I double click into that?
Yeah.
Because Youngbo, I really appreciated you back-channeling with me, but I want to sort of surface this for the community. I think that your litmus test here makes a lot of sense if the expectation is that the audience understands and wants to see social and climate justice, which I don't think is the case for traditional finance actors, right? So I'm talking about like the very large traditional players that aren't going to be spending a lot of money on impact measurements and reporting at any rate. So to have them do any sort of rigorous but-for testing, like a randomized control trial or anything even remotely rigorous, I think is just impractical. So I take the position that even within impact investing, only actors like Maya and Carolyn at Open Road Alliance can really say that what they're doing is additional, that everyone else is just trying to do it. And I don't feel like the ESG curious asset managers on Wall Street that I'm liaising with would care whether or not anything nice that happens is because of their investment or not. So even the test itself, I think, would defy their mental model. Well, I apologize for being such a cynic.
Understood. It's probably just that subset. What I'm getting at is that perhaps if you're in talk to those in Brussels or the European Commission, that it could be a role for that side to play, for one. And also, I'd say, is they're fundamentally to translate this into a way that a fund manager could grasp, would be considering, and this is literally borrowing from the language of pension funds, literally, that if you translate how to grasp it is, you can have one coupling language from the EU taxonomy is what would be a defined significant contribution, as in this, in terms of the SDGs, this is what's a climate, for example, this is what needs to happen by the year 2030. This is how much CO2 needs to be reduced, how much carbon needs to be removed when you get net zero. So this is what needs to happen, and figure out what is the most viable, what's the most proper way to get there, what's the best pathway. And the other approach to describe it would be really as if you control them very, in terms of set your target. It's almost like, not exactly, we could think of it as a very loose analog of a defined benefit approach is what would be a target rate of return? Let's say you want 5% nominal or 3% real, assuming 2% rate inflation. If you're looking for that type of target, then given that target rate, what would be your approach? What would be an allocation that would maximize the impact when measured or assessed against the 17 SDGs? So that might be a way, to translate to fund manager.
Thank you for bringing both of you that sort of side discussion out into here. I think to sort of bring it back to some of the themes that I feel have been circulating since the start in this discussion about the distinctions, there is a risk, is there not, here that, and it came up in the last discussion, that we spend a lot of time in this community defining and, you know, drawing lines around what counts as what. When the reality is that if there's something like $379 trillion in capital, we've got like 0.002% or something, which is actually self-defined as impact investing, and we're trying to kind of further squeeze and define that. I think we have this challenge with the moving to the system level thinking that I want to bring out here in terms of the practical steps to get this conversation going. As came up in the last discussion, there is significant difficulties, as I think you're raising, Shu, as to raising ESG integration as a first step with some more traditional fund managers. It's still, despite the huge growth that everyone's talked about in the last year, a minority pursuit across the entire sort of financial industry. So how do we go back to that sort of purpose and discussion around posing this perhaps a systemic risk, to the point that was raised earlier by one of the speakers about that's the kind of more palatable entry point, it seems, for this discussion. Is that true? Is it a question for this group, or are we sort of pitting ourselves that we've just defined a new term that we think will be more palatable to sort of get some of these items on the agenda? Interested in thoughts on that as we have just a few minutes left, and as we start to think about where next with these kind of discussions in this group. Bill.
And I would say just really quickly on that. So it's interesting when Steve and I were kicking around the term with John in turn, one of the things that we were trying, I came at this from more of the private market impact investment world. Steve came at it more from the ESG integration, sustainable investing public world. And we both had this kind of acknowledgement of the frustration, which we've all expressed here in varying ways, of what we were all individually accomplishing as impact investors or as sustainable investors. And so this was really an attempt to say, there's a lot of good that's being done, but we're just not getting, like, we're clearly not transforming systems. These pesky problems are getting worse. And it was just that acknowledgement of the shortcoming. And as we started to more and more kind of embrace the discipline of systems dynamics and kind of understanding, if you're going to get to that level, I mean, system level, that's not just us saying the difference between portfolio and system level, that's an actual systems dynamics term, right? And so it's really trying to embrace that kind of thinking into this, because, yet again, we talk about materiality and all that, and I think all the standards that a lot of these setters or groups are doing is great. It's just like, what's material today may not be material 3 months from now, right? Or 3 years from now. And so it's just that idea that there's a constant kind of dynamic quality here that just isn't quite captured in a lot of these existing strategies. And this was an attempt to try to say, we've got to go to this next level and we've got to take this big step, and it's going to require a big conceptual leap. But finance has done it before, and I think it's currently in the midst of doing that now. So
I wanted to just to go back to something that was mentioned at least half an hour ago. I think there's a really old and complex, but not foregone dynamic between not just materiality, but as part of materiality, but the notion of different kinds of risk. So, which is obviously a material factor, right? So if you have reputational and regulatory risk, to take two obvious examples, those become material to the extent that they are, quote, big or impactful. I for one think the stuff that's going on in, it may be a significant, sorry for my dog, he agrees with me. Hey, Willow, hush. The problem of Zoom life, right? I think there's a critical role of what governmental and intergovernmental actions do at local, state, and federal and global levels. Because if you look at financial and other reforms historically, it strikes me that rarely have you had any significant movement absent a real push, and I'm not terribly optimistic about this in the immediate, on a governmental level. So you can have an element of finance at the moment, which we are part of discussing. And I think that can have significant impacts, but mostly to show what is possible and quote, what is necessary. And so if you go just on, if you go into the issue of what's going on in the UK in terms of defining capital and defining leverage, at the end of the day, that's going to be a regulatory action. And I think the same is true around a whole host of systematic and systemic risks. And then they become material for businesses and finance, and they're going to react in a host of different ways. You're not going to have a unified voice, you never do. But it shows what's possible, and it also may be an element of competitive strategy. There's obviously huge literature on that.
Thank you, Jim. And we do, I'm afraid, need to bring it to a close here. I know there are further questions, but encourage you to, I've asked the speakers actually if they can put their email in the chat to share in case you would like to reach out to any of them directly. We are reflecting and debating on where to go next with this. Dimitri, thank you for your support today. I'd ask you if you would be willing to put the survey link in the chat, because we really want to get your further thoughts on some of what you've heard today, how you're taking this forward in your own day-to-day work. So thank you today for sharing your questions and thoughts and some of the challenges. We are keen to take that forward. We've already heard the idea from Delilah of workshopping some of these initiatives, some of the ideas that came through in the ESG 2.0 paper. So I would really encourage you to reach out to Delilah if you want to be involved in that, and to reach out to any of us, of course, on the aspects that we've discussed today. We will be rethinking and would welcome your ideas on if you want to continue discussions in this kind of format and how we can reach out to others as well. But that just leads me to say, you know, maybe I think we're looking towards getting to the point to Mrt's comments where not just ESG is your job, but system level investing is your job. How do we provide the tools and the frameworks that can enable investors to do that job? And so would love to hear your thoughts and ideas. Please do consider doing the Survey Monkey, and just a really big thank you to all of our speakers today and to all of you for engaging in the chat so actively. Thank you, everybody.